Hey guys, this is Rudy coming at you live from Palm Beach in Florida. It is Saturday evening. It is approximately 8:15 p.m. And during this week, I put together a little bit of content I want to share with you about the decline of oil, the crashing and burning of the commodity that many of us are invested in. And let's take a little bit of a deeper dive to see what's happening in the marketplace as we know it. So the objective behind this particular presentation is to talk about why oil is declining and what is actually really the situation going on with oil in the marketplace today. So by way of a little bit of background, the news over the past week, so you can see the screenshot here that I'm showing you from Yahoo Finance is 4 days ago. This is actually on Tuesday of this past week. Oil tumbles 5% on a report that Israel won't target Iranian crude, right? So bad news because Israel is not going to knock out Iranian crude. IEA prediction of supply gut. Now, the IEA, for those people who don't know, is the International Energy Agency, which is really just a US propaganda mouthpiece. So you need to take the information that they share with you probably with a pinch of salt from time to time. On the left side here, second headline, US gas prices could fall below $3 per gallon. Of course, that's very, very necessary because there's an election coming up in now about 2 weeks from now. And then at the bottom, oil prices tumble as OPEC cuts demand outlook. On the right-hand side, you see the pound, gold, and oil prices are in focus, commodity and currency check. Towards the bottom, oil to fall to $70 even with Hurricane Milton. So regardless of hurricanes and all this kind of stuff, oil is just dropping and crashing. Falling gas prices, not enough to offset hotter than expected inflation in September. So those are the kind of headlines. We see them every day. So what I try to do as best I can is see if I can source other news that is probably not bought and paid for the most part by the US government, and they're not very easy to find, right? So here's a Russian news publication or newspaper. I'm not particularly sure because I don't really read Russian. It's fairly recent. It's from October 14th. That one I can understand. The date down here at the bottom. I have no idea what this is, but fortunately I have a friend named Google, and Google kindly translated this for me. And I'm going to just assume that the translation is correct. And if I'm not, and for the people who are Russian speaking, you can tell me if this translation is correct or not in the comments. So OPEC maintains its estimate of liquid hydrocarbon supplies from countries outside the OPEC plus deal, right? So there's a couple of little phrases here in this particular one sentence: maintains the estimate of liquid hydrocarbon supplies. And then the second part, from countries outside of the OPEC plus deal. Now, the article itself, which, as I said, was translated by Google, has this little section in it, which I copied and pasted. It says OPEC left its estimate for liquid hydrocarbon supplies from non-OPEC plus countries unchanged for 24-25, while demand from OPEC plus countries will decline by 0.1 million barrels per day. So 100,000 barrels per day, 100,000. Keep in mind that companies like Occidental Petroleum produce about 1 million barrels a day, just Occidental, and other companies like Petrobras, more like 2.5 million per day. So 0.1 or 100,000 barrels is literally nothing. It's almost a rounding error in the greater scheme of things. And by 0.2 million barrels per day in 2025. So respectively, a little drop here in 2024 and a slightly larger drop in 2025. It is negative. In other words, there is a reduced demand in terms of this particular supply question, and supply and demand at the end of the day drives most commodities, except as we get close to a US election, supply and demand goes out the window. And it's more important to give people a respectable and decent price at the pump in order to secure some votes. US crude oil production growth has been revised upwards by 0.04. That's only 40,000 barrels per day for 2024, and is expected to increase by 0.55 million barrels per day to 21.52 million barrels per day. That's US production. So US production is expected to exceed 22 million barrels per day, says the Russian news media. Production of liquid hydrocarbons in non-OPEC plus countries in 2025 is expected to increase by 1.1 million barrels per day to 54.2 million barrels per day. thanks to the same America, Brazil, Canada, and Norway. What's interesting here, just as a sidebar comment, is the fact that Saudi Arabia has actually reduced its GDP forecast. Um, Currently, they're going through a fiscal period where, because of the low price of gas, they're not able to generate as much revenue as what they had hoped to generate. And as a result, they've reduced their GDP forecast down from around 4.4 to just a fraction. It's now 0.9 or something for 24, 25. So there are some sort of downward pressures on the market in general. Let's get back to this presentation here. And let's take a quick look at the channel. So a couple of people on the channel commented. So the first one was down here on the right. Costi28 said, due to the elections in the US, the oil market will be at its 52-week low on 20 to 25 October. Of course, that's the period where we are in now. Could you analyze Devon, Oxy, Ecopetrol, and Petrobras in parallel? Well, sure, Costi, I said I would. And here it is, right? So but what I did was I like to do a side-by-side comparison of 5 different equities. So I included XLE, which is my ETF, which I have quite a large position in, because that gives me 3 of the 5 that I actually personally have a position in that I'm long in, which gives me a little bit more standing in terms of discussing it with you. And then a few hours ago, Jihad commented and said, any quick thoughts? EC, so it's Ecopetrol from Colombia, is so low. Is gold and silver a better buy than oil? Well, that's an interesting question. So we'll see if we can answer that as we go. And by the way, in the previous video I made, I mentioned 5 micro cap stocks that you might be interested in adding to your watch list or even investing in. So you can take a look at that too, because it includes some miners. The comment that I made back, the reply to Jay Hudge, was to say, I'm not confident we've seen the bottom of oil or Ecopetrol yet. And regarding precious metals, I prefer smaller cap gold and silver miners to physical gold and silver. Many of them are cheap, producing and benefiting from the high commodity prices. Uranium miners are also attractive, and many have started a stock run already. So a stock price run already. See, the thing is, rather than buying physical gold or silver, which obviously some people do, and good luck to them and best of success with that strategy, my preference is to actually invest in a miner that produces or develops the commodity. So in other words, I'd rather own the stock of a gold mining company or silver mining company, especially if it's undervalued, rather than the actual physical commodity itself. The reasons for that are multiple. I like to invest in things that generate revenue, that create jobs, that develop and produce free cash flow for investors, return some dividends, and obviously an increased stock price to investors rather than the commodity itself, which sometimes you can buy and just sit and stare and look at because it's shiny. Right, so here's a side-by-side comparison of 5 different equities, and at the bottom you can follow along because I put them in alphabetical order. So on the left-hand side I have Devon, then Ecopetrol from Colombia, then I have Occidental Petroleum from the United States, Petrobras from Brazil, and XLE is my catch-all. It's an ETF, an exchange-traded fund. Its largest position is Exxon, and the other positions in XLE are top-rated US oil and gas energy producers. So if we look at these 5 stocks, they're not necessarily the same, so they don't necessarily belong side by side, but for the sake of this particular discussion, I'm just going to assume they sort of oil companies in general, and therefore we can compare them one to the other. So Devon, oil, US exploration product, EMP, Ecopetrol, emerging markets, an integrated company, so Colombia being the emerging market, Oxy, oil, US integrated, Petrobras, emerging markets, again, Brazil integrated, and XLE, that's not applicable because XLE, as I said, is an ETF. It's an exchange traded fund. 2 of these are different to the other 3 because Ecopetrol and Petrobras are ADRs, which are American Depository Receipts. If you're a US tax person, you don't actually own the stock. You're buying the American Depository Receipt. One thing that I like to look at here for the technical geeks is the 20-day the 20-day raw stochastic. And the reason why I've highlighted this here is because, as a general rule, when you get to above 80%, it's overbought. None of them are above 80%. But if it dips below 20%, then it's hopelessly oversold. So based on this graph here, you can see Ecopetrol is sitting at a 0, and Petrobras at 12%. Are hopelessly oversold. So one could argue just from one particular benchmark on the technicals indicator that based on the raw stochastic, Petrobras and Ecopetrol might be buys right now, and to a lesser degree, maybe Occidental Petroleum. And I'm going to show you more about these stocks in just a minute, because I'm going to go through all 5 of them very briefly, so that you can make better quality decisions on where you'd like to go with them. Also, if we look at the price earnings ratio as a second indicator, generally the lower the PE ratio is, the cheaper in relative terms the stock is. And in this particular example, we have Ecopetrol at 3.85 and Petrobras at 4.4. So they're super cheap. And even the energy index, XLE, is sitting with a PE of 8.87. So all the oil companies, relatively speaking, are cheap right now. The other thing that's interesting here are the analysts. So analysts, right? Sell, 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 sell. Little exception here on XLE. It's a bit of a safe harbor from the point of view that if you're not willing to take single stock risk by investing in one of these 4, for example, you can rather buy XLE and just kind of set it and forget it, put it in your portfolio, and you don't have to worry about it too much or worry where it's going to go. It'll be okay, especially if you hold it for a few years or so. What I like to do here on the key statistics is take a look at the company's annual sales, which is on this 3rd row over here. And this number, as you can see, with all its zeros, is in billions. And then at the top, we have market cap, which you have to multiply by 1,000 to make it into, in this case, billions. So we have a $27 billion company here. So we look at Devon as an example. So what I'm doing is I'm taking the annual sales, which in the case of Devon is about $15 billion, and dividing it by the market cap, which is $27 billion. And it gives me a percentage of 56%, which is quite normal. You can actually see Occidental is almost the same, right? $28 billion in sales with a $48 billion market cap. This is sort of typical of most of the larger players in the market. And these are the outliers. Look at Ecopetrol. It is so incredibly cheap. Ecopetrol currently generates 171, almost $172 billion in annual sales, and it has a market cap of only $17.8 billion. The market cap, in case you've forgotten, is the number of outstanding shares multiplied by the current stock price. So the shares haven't changed much, but the stock price is so low that it's giving Ecopetrol a market cap of only $17-18 billion. Similarly, but not quite as wild as Ecopetrol, is Petrobras with more than $102 billion in sales per year, with a market cap of only $96 billion. So at a glance, using this as another benchmark, you can see that these two guys, Ecopetrol and Petrobras, are relatively speaking very cheap. Now, once again, if you are concerned about the volatility and you are not really comfortable holding single stock because of single stock risk, buy the ETF if you want to invest in oil and gas stocks and hold that instead, and you sort of mitigate the risk across that basket. If you've been holding these 5 equities, you haven't been doing really well. The only one that actually has been performing okay is XLE, which, by the way, also pays a dividend of about 3%, just over 3%. So if you're up 7% plus 3% in dividends, if you can reinvest them, then you're up over 10% for the year, and that's not too bad. The other guys, including Warren Buffett's favorite right now, which is Occidental Petroleum, I'm looking at here year to date, right? So it's about 10 months or so, 9.5 months, down almost 13.5%, and you're not buying Occidental for its dividends. So you're just eating the loss there on paper until things return better than what it is currently. Ecopetrol, the worst performer of the bunch, year to date down almost 30%. Now, you can go with the Warren Buffett philosophy on that and say, I'm going to buy when everyone else is selling. And then you must also remember to sell when everyone else starts buying. Let's look at all 5 of these very quickly. It's just a quick snapshot. I'm looking over a 3-year term, so you can see the graph looks really ugly for Devon. I have actually lost faith in Devon's management and their ability to execute strategy. and strategically. They enjoyed a huge benefit when their stock price was nice and high, and the oil and gas prices, sorry, the oil price on a per barrel basis was well over $100 a barrel. They were making money hand over fist, and they didn't do great things with the cash that they were generating. And as a result, I kind of lost a little bit of faith in Devon Energy's management team. You can buy for around $40 or so. It's super cheap. If you had opened a new position in Devon just over a year ago, you would have bought it for around $77. So you down almost 40% or so. You can buy it for its dividend and just hold it. I think if you had to hold Devon for about 3 to 5 years or so, you'd probably be okay, especially if you can reinvest that dividend because you get a nice little hedge here of around 4.5%. It's also a unique company because they pay a combination of a fixed and variable dividend, and the variable is based on their free cash flow, so they're not too bad. Devon had a pretty bad day when I took the screenshot, which was October 15th. I think that was Tuesday. And then over here on the right-hand side, you can see the Trading Central Value Analyzer shows you short-term sentiment is bullish, and the intermediate term sentiment is also bullish, but then we go strong bearish evidence on Devon longer term. I no longer have a position in Devon, so Devon is only of academic interest to me, and I have no intention of opening up a new position in Devon Energy. I also do not have a position in Ecopetrol. This one is super cheap. You can buy it for about $8, but you need to be comfortable with the volatility and the risk, right? You can buy this one for its dividend. I mean, in theory, you could say even if they cut the dividend in half, you're almost making 20% anyway. Currently, the dividend is sitting at almost 40% over the last 3 years or so. It looks horrible. I can actually remember looking at Ecopetrol when it was at about $18, and I covered it a number of times and talked about it in videos that are in the library when it was trading sort of at around $10. And I remember saying several times you can buy Ecopetrol for about $10. If you did, you'd be down about 20% or so. It's not too bad, but look at the value analyzer here. The sentiment, short term, intermediate term, and long term is very bearish. So I'm not too sure, as much as I'm not too sure on oil hitting its all-time low yet in terms of where we are right now. I don't think Ecopetrol has seen its lowest price yet. It's currently trading at its 52-week low or thereabouts, but I think it can actually pull back a little more from where it is currently. I still do have a position in Occidental Petroleum, but unlike that famous investor Warren Buffett, I have not been buying Occidental Petroleum at $60. My cost basis is actually around $10, and that's not a bad position for me to be in, and that's the only reason, or the primary reason, why I actually still hold Occidental in my portfolio. You can buy it now at around $50. It's arguably not a bad buy if you have a time frame of, let's say again, sort of 3 to 5 years or so. I actually still have a fairly large position in Occidental Petroleum. One of the reasons why I keep it is because it's currently yielding approximately 1.6% at $50, right? So the dividend is expressed as a percentage of the stock price. But my cost base is only $10. So there's a 5x there, which means I can multiply this by 5. And if you multiply 1.6 by 5, you get 8%. So I'm currently earning an 8% dividend on my Occidental stock. And I reinvest that into more stock, which pushes up my cost basis a little every time they buy dividends, but not too much because the dividend is so small. But look at the value analyzer here as well. Weak, right? So if you look at short term, it's weak. If intermediate is strong bearish, and long term is strong bearish as well, right? So maybe now is not really a good time to get into Occidental Petroleum. As for me, I'll just keep mine. I do use it sometimes to do some tax loss harvesting. So for instance, if I had to sell some Devon at a loss, I might also sell some Occidental at a profit, and therefore it's sort of a wash buy and sell, and I don't make any profit for tax purposes that would be due and payable. Petrobras is also one of my long positions. I've had this one in my portfolio for quite some time. I have traded out and back in to Petrobras a couple of times. I have a fairly large position in Petrobras. They did cut their dividend. Now they're paying about 18%, which is obviously phenomenally good. Unlike Ecopetrol, it hasn't fallen off a cliff. It is down, but not too badly. My cost basis on Petrobras, I actually have Petrobras PBR.A, which is the preferred shares, and my cost basis on those is around $13 or so. So for me, this one's kind of treading water, except for the fact that I am also earning and reinvesting the dividend. every time I receive a dividend payment, which is intermittently from Petrobras. Many of these companies pay you a quarterly dividend. Petrobras does, who knows, whatever happens next. On the value analyzer, you can see that the short-term sentiment is still bearish, but then intermediate it goes bullish before predictably they say it will go bearish again. Longer term means beyond 2025. But to be fair, the same people who can't tell us what the weather is going to do tomorrow probably can't tell you what the stock's going to do in 2026 or beyond. This is the XLE. If you do invest in an exchange traded fund, you need to know that you need to pay a little fee to the people who are managing the fund on your behalf. This one's not too bad. The fee, like I can see it on the screen right now, fast enough for you to share exactly what it is. Let me see if I can quickly find it. No, but anyway, it's approximately 0.1%. So right here at the bottom, in the middle, 0.09, so approximately 0.1%, so 1/10 of the percentage your management fee on an annualized basis that you will have to carry as a burden when you buy the ETF as opposed to buying a stock, where obviously you wouldn't have to pay a fee at all. As I said earlier, it does pay a dividend of around 3% or so, and then the annualized returns. So on this one, I don't have a tool where I can actually sort of predict the value of the stock on a short term and intermediate and longer term. But I can look at the annualized return, which is obviously looking in the rearview mirror. But you can see over a 10-year period, it's generated approximately 4%. And then the 5-year and 3-year performance has been stellar. The 3 years specifically, because it includes the period after COVID-19. So going from 2020 into 2021, when Brent touched $130 per barrel, and obviously everybody's making a lot of money. So if you've been in XLE for a long time, as I have, you can average these out and you're comfortably up, 10, 12, 15%, depending on your cost basis. And in addition to that, obviously you can sock away your dividend. So let's just quickly take a macro look at the market as a whole and see if we can figure out where energy is going on a go-forward basis. So this is kind of a look back, right? It's the average Russian oil exports by country and region. And you'll notice the change here. So 2021 and 2022 was not too different one from the other, but look at the change that happened over here. And if you look at the big blue block, right? So the light blue block has kind of just dropped down a little. That's the European Union. And I think probably most people watching this video would know why. But look at the growth in the blue block, right? So blue went from here to here, that's China. And then the yellow one is India, right? So India was just a small little smidge on this 2021 vertical chart, and then became a little bit bigger, and now it's large. It's actually catching up to China. So most of the Russian oil export, looking back, have been going and growing as they sold more and more of their energy products to China and India, which makes sense because they're obviously also neighbors. And in addition to that, many of the Western countries don't want the cheap Russian crude right now for political reasons. So we'll skip that one. This graph, by the way, comes from the IEA, which is the International Energy Agency. Now, if we look forward and we look at the global coal consumption, and the reason why I'm using this is because coal is still the primary resource for making electricity, for generating electricity. So once again, you can see I've highlighted here at the bottom left, China and India. They're the light blue and dark blue line. You can see the growth, right? So even though considering where we are right now, which is sort of over here, 2024, there's expected to be a bit of a decline in China in terms of their coal consumption. Overall, this graph is kind of trending up, not down. And you can see the breakdown here in terms of the estimates for 2026. And overall, even though on a per country basis, it might be dropping a little, overall, it is actually still edging up and up higher. And this graph also from the International Energy Agency. And now the last one I want to share with you is the global oil demand forecast 2017 to 2030. And the reason why I put this green arrow in the middle of the screen here at the bottom is because 2024 is where we are currently at. Now, if you look at this line sort of at a glance, and you can ignore the breakdown because I didn't include the legend here to tell you what these are, you can just look at that skinny little orangey line right at the top, right? So this is where we are right now. And you can see we've been using more and more and more oil every single year that goes by. And this line is trending slightly up again and again and again. So if you follow this curve of this line, you can see it's just edging up a little more every single year. And there's 100 there, which is 1,000,000 barrels per day. And the reason why I wanted to share this with you is because currently, globally, we are using just over 100 million barrels per day. I think it's about 102 and a bit per day, and obviously it varies from time to time. But the 102 million barrels per day incrementally is just more every single day, every single week, every single month. We use a little bit more what we affectionately know as fossil fuels. In other words, it's growing incrementally every single day. And almost everything we see and touch, even everything that you see on the screen right now, including the devices that I'm using to record this video, requires some component of oil or energy products in order for us to have clothes, have food, have furniture, drive cars, etc. So that growth in fossil fuels is going to continue for a few more generations. Certainly, fossil fuels, if we're allowed to call them fossil fuels, will be around for much longer than me or you or anyone else who might be watching this video in the future. But that's the macro thesis, right? So I gave you sort of three pictures with this particular video. The first one was just the view from a different perspective, maybe looking at a different country and how they report the news as it relates to oil and gas. I gave you the 5 side-by-side comparisons, and including one of my favorite, which is XLE, the ETF, and then ended it with a little bit of a macro thesis to show you that oil, with all the downward pressure and all the government interference and the political green huggers, tree huggers who tell you that we're all going to die if we don't stop using fossil fuels, we use more and more of it every single day. So it remains one of the most logical and simple investment theses that you can possibly subscribe to, because anytime you have a commodity which people are using already in abundance and use more and more and more of on a daily basis every single day, it's not a bad place to park at least a little bit of your money. And if you're scared, don't invest more than 5% in oil and gas, and of that 5%, stick a chunk of it into the ETF to mitigate risk as it relates to single stock risk. And you know what? If you're patient and you do the right thing, you don't have to be a rocket scientist to make money in the stock market. So on that happy, cheerful note, this is Rudy saying thanks for watching. Take care. Bye-bye.